Hey everyone, welcome back to the channel. In today's video, we're diving into a fascinating topic that's rapidly transforming the financial industry, AI in credit scoring. If you've ever applied for a loan, a credit card, or even a mortgage, you've probably encountered traditional credit scoring systems like FICO or VantageScore. But what if there's a better way? Well, AI is making its mark, and it's changing everything. So let's take a closer look at how AI is revolutionizing credit scoring, how it's addressing some of the flaws in traditional systems, and what it means for lending and borrowing in the future. Traditional credit scoring systems and their problems. Now, before we jump into the world of AI in credit scoring, let's first talk about traditional credit scoring systems. These have been the backbone of how lenders evaluate individuals for loans and credit for decades. The most common one is FICO, which takes into account factors like your payment history, credit utilization, and length of credit history. But while these systems have served us well for a long time, they're far from perfect. One of the biggest issues with traditional credit scores is their limited scope. A lot of people with little to no credit history, like young adults, immigrants, or people recovering from financial hardship, can have low credit scores, even if they are responsible with their finances. These traditional systems often overlook many factors that might better reflect a person's true creditworthiness. Another problem is the lack of transparency. Many people don't fully understand how their credit scores are calculated, or how certain actions like missing a single payment can drastically affect their score. This creates a lot of confusion and frustration, especially when it's difficult to know exactly how to improve one's score. AI's role in credit scoring, revolutionizing the system. This is where AI comes in. Unlike traditional credit scoring, AI can process vast amounts of data and identify patterns that are not immediately obvious. It can evaluate a much broader range of factors, including things like your spending habits, social media activity, and even your behavior in online environments. This means that AI can potentially offer a much more accurate and holistic picture of someone's creditworthiness. By using machine learning algorithms, AI can learn from historical data and continuously improve its predictions. This allows AI to predict credit risk more accurately and more fairly, especially for individuals who may not have a long credit history. With AI, we could see a future where credit scoring isn't just about credit card payments and loans. It could include things like your rent payments, utility bills, and even subscription services. For example, AI-powered systems could use data from a person's bank account to see their cash flow and spending patterns. If they consistently show a positive balance, pay bills on time, and manage their finances well, AI could determine that they're a low-risk borrower even if they don't have a traditional credit score. The impact of machine learning on credit risk analysis. One of the most powerful aspects of AI is its ability to analyze credit risk using machine learning. Unlike traditional credit scores, which rely on static models and fixed rules, machine learning can adapt and learn as new data comes in. This means that AI can constantly refine its predictions, making the credit scoring process much more dynamic. For instance, machine learning algorithms can analyze patterns in individuals' payment behaviors, credit utilization, and even their debt-to-income ratio in real time, providing lenders with a more up-to-date and accurate assessment of a borrower's risk. Moreover, AI can detect potential fraud more easily than traditional methods. By learning to recognize unusual patterns in an individual's financial behavior, AI systems can flag potential fraud or identity theft, offering a layer of protection for both the lender and the borrower. Big data and alternative credit scoring models. One of the key innovations in AI-based credit scoring is the use of big data. Traditional credit scoring systems are limited to the information that's in your credit report, things like loans, credit cards, and payment history. But AI can incorporate a wide variety of data sources, including non-traditional sources like utility bills, rent payments, and even your online shopping habits. This is where alternative credit scoring models come into play. For individuals with little to no credit history, traditional credit scores don't provide a fair assessment. However, AI can take into account a much broader range of data to give these individuals a fairer chance at securing credit. In fact, alternative credit scoring has the potential to democratize access to credit. For people in developing countries or those with limited access to traditional banking, AI-powered credit scoring systems could provide access to loans and credit cards that they may have been denied under the old system. Privacy and ethical concerns. While AI's potential to improve credit scoring is exciting, it also raises significant privacy and ethical concerns. AI systems need access to vast amounts of personal data in order to function effectively. This raises the question, how much data is too much? There's a fine line between using data to predict credit risk and violating privacy. People may feel uncomfortable with AI systems analyzing their social media profiles, shopping habits, or even their personal relationships. This data could be used in ways that they don't fully understand or consent to. Additionally, there's the risk of algorithmic bias. AI systems are only as good as the data they're trained on. If the data used to train AI algorithms is biased, it could perpetuate existing inequalities in lending. For example, if a machine learning model is trained on historical data that favors certain groups over others, it could unintentionally reinforce discrimination in credit scoring. This is why it's crucial to ensure that AI systems are designed and used responsibly. Companies must be transparent about the data they use, how they use it, and the biases they may unintentionally introduce into their models. Building safer and fairer credit systems with AI. Despite the challenges, the future of AI in credit scoring is incredibly promising. With the right safeguards in place, AI has the potential to create a more secure and equitable credit system. By providing a more holistic view of creditworthiness, AI could help level the playing field for individuals who may have been underserved by traditional systems. It could also help to reduce discrimination and bias by relying on more diverse and inclusive data sources. Ultimately, AI could build a more inclusive financial system where credit is available to more people, regardless of their background or financial history. For lenders, this could mean better risk management and more informed decision-making, leading to healthier financial ecosystems. So, there you have it. AI is not just the future of technology, it's the future of finance as well. By revolutionizing credit scoring, it promises to make lending and borrowing fairer, more transparent, and more efficient. But like all technology, we need to proceed with caution, ensuring that privacy is protected and that bias is minimized. If you found this video insightful, don't forget to like, comment, and subscribe to our channel for more content like this. I'd love to hear your thoughts on AI in credit scoring. Do you think it's the future, or do you have concerns? Let me know in the comments. Thanks for watching, and see you next time.